Understanding of what the U.S. Federal Reserve might do going forward, I'm now joined by Kathy Bostjancic. She's the Director of U.S. Macro Investor Services at Oxford Economics in New York. Hi, Kathy. Thank you so much for joining us. It's great to have you on the show tonight. Uh, you just heard Steve there. Very few respondents to that survey actually believe that the Fed will hike this time around. In fact, the possibility is almost nil. However, a December rate hike seems to be on the card. What are you expecting? Do you think the U.S. economy is resilient enough for the Fed to hike in December?
Yes, well, thank you for having me on your show. And I think that's what's going to be very important today with the announcement and the press conference is if they don't raise rates, as you said, the majority of market players and also economists do not expect that. Do they give us a signal that a December rate hike, or at least a rate hike by year end, is in the offing? Most do not believe that the Fed would want to hike rates just less than 1 week before the U.S. elections. So that meeting in November, very low odds. If they don't go today, they would go in November. But December, in our view, the economic data are lining up to support that. In fact, we would actually argue the Fed should actually go ahead and raise rates today. But as was pointed out by Steve Leisman in the survey, the markets are prepared for it, and that is a problem. The Fed officials would have to really say that we are raising rates and let the markets be able to adjust in a healthy fashion.
Right. Also, just to explore the faint possibility that the Fed does indeed hike this time around when we get the statement in another hour and a half from now, what do you reckon the impact is going to be like?
Well, if they surprise the markets, we certainly would have quite active and volatile trading. Now, you could make the argument the Federal Reserve should go ahead and do that because, as also was pointed out, many are worried that the markets have become extremely overly reliant on easy monetary policy, and also the fact that everything should be televised ahead of time, that there should be no surprises. Maybe this is an opportunity to take that chance, but my suspicion would be that the Fed would hesitate to do that, and probably would not, just because it's such uncertain times, especially with the markets and the economy, that they don't want to take that risk. But again, there's a real argument that to be able to sort of wean the markets off of this stimulus, and also from sort of forcing central banks' hands, that you go ahead and surprise them. So it would be quite rocky. I think the equity market and bond markets would sell off quite sharply in the U.S. and also globally.
Right, Kathy, point taken. Now, I also want to discuss the macroeconomic numbers with you. We've seen inflation at the 0.7, 0.8% mark for a few months now. Now, we know that the Fed's mandate is close to 2% or around that mark. So to say, what do you think the Fed needs to do now to meet that objective? It's been elusive so far.
Yes, that's right. It's been especially the headline readings for the personal consumption expenditure price index, which is their preferred measure. It's been very difficult to see the numbers go higher and move towards their target. However, I think what's also going to be very important in the statement and the data that are released, the Fed's going to update its summary of economic projections. You really want to focus on the medium-term forecast for inflation. So, for instance, for 2018, that's when the Federal Reserve thinks they eventually will hit the 2% target. Be very interesting to see if they've revised that at all. Do they lower it and back away from that a little bit? That would give us a signal that they're not. They're even a bit less hawkish and less eager to raise rates. So I think that's going to be very telling. If they maintain that forecast and they say, okay, by the end of sometime in 2018 we'll hit 2%, to me that gives more green light or more confidence that they would raise rates in December and then again follow up in 2017 with additional rate hikes.
Right, Kathy, and what about the jobs market now? Earlier today, Larry Summers, he did go on a rant of sorts on Twitter, where in one of the tweets, and I'd like to take you through that, he says that the Fed should not raise rates because total hours worked in the US are flat to down over the last 6 months. Does that negate an overall strong growth in the US jobs markets that we've seen? In fact, it's been averaging around 232,000 jobs over the past 3 months. What do you make of those comments, and do you see the data as strong data?
Well, we've actually, I guess, I would take the other viewpoint and say that we've actually seen quite a resilient and strong labor market, and also employment gains, and also hours contribution. In fact, as a share of GDP, employment is making up quite a big portion of our growth, and that's why productivity growth has been so low. So I think in terms of the employment mandate, especially when I try to measure how much excess slack is in the labor market, particularly if you look at the broad U6 unemployment rate, it looks like we've closed that gap quite meaningfully, and essentially closed, not quite, but we're getting very close. And the question is, the Fed is so far away from what anyone would estimate as neutral Fed funds rate, even if you think it's on the low end of the ranges out there, with a midpoint of 37 basis points. Should they really wait until you hit the goals, the mandates, before you start to raise rates? By then, they could potentially be behind the curve.
Right, Kathy, I'd like to speak with you more, but unfortunately, I'm completely out of time on the show. But we'll definitely have a conversation once again, depending on what comes out from the Fed statement later tonight. Thank you so much for joining us on the show tonight.